This week, options trading activity surged, with NVIDIA and Tesla at the center of the action. NVIDIA, NVDA. Options. Activity NVIDIA options volume skyrocketed around its earnings, making it the most traded equity option on Thursday. Implied volatility, IV, spiked, with market makers pricing in an 8 to 10% post-earnings move, which proved accurate as the stock swung accordingly. By Friday, NVIDIA's IV declined as the earnings event passed. Tesla, TSLA, options. Surge after Tesla's 8% drop. Put option activity spiked, with traders hedging for further downside. Tesla's put-call ratio jumped above 1.0 midweek, signaling more put volume than calls, a bearish and hedging indicator. This was notable since Tesla typically sees high call option speculation. However, by week's end, bargain hunters returned, buying calls again. Broader market option trend CBOE. Equity put-call ratio hit 0.68 on Wednesday, the highest level in weeks. This suggests investors were rushing to buy protective puts amid the S&P decline. By Friday, the put-call ratio eased back towards 0.60 as market fears subsided. This week, derivatives positioning highlighted key trends, with short-dated options dominating volume and amplifying volatility. Surge in short-dated options, 00 DTE trading activity, options expiring within a week, or even same-day, 0 DTE options, attracted. Massive trading volumes, increasing intraday volatility. On Thursday's sell-off, many put options moved in the money, market makers hedged by selling futures, further accelerating the decline. Bloomberg and CNBC analysts noted that the prevalence of 0 DTE options contributed to both the sharp drop and rebound. Implied volatility skew and market sentiment early in the week. The implied volatility skew steepened. Out-of-the-money puts became expensive as investors paid premiums for crash protection. However, by Friday, the skew flattened slightly, implying reduced demand for tail risk hedges as market sentiment stabilized. In short-term options trading played a major role in market swings this week, reinforcing the growing impact of 0 DTE options on intraday price action. This week, the VIX futures curve remained in contango, upward sloping, but the gap narrowed as the front-month VIX future spiked. Key takeaways from VIX futures movement. Such short-term fear spikes are typical during volatility events. The market expects this surge to be temporary, as long as the VX drifts lower next week. By week's end, the VIX closed around 19, which is roughly in line with the past year's average. Market implications. Despite the volatility scare, markets are not yet pricing in sustained turbulence. If a VIX levels decline next week, it would confirm the market's expectation of temporary volatility. This week, options-based sentiment indicators and single-stock options trading were key market themes. Options-based sentiment indicators, the put-call ratio rose to 0.68 elevated, but not at extreme panic levels, 1.0 seen in major sell-offs. Suggests institutional investors were already hedged, reducing the need for panic hedging. Open interest data shows that many existing put positions were monetized during the downturn. The CBOE skew index, which tracks tail risk pricing, ticked up only mildly, implying no major stress pricing. Single stock. Options speculation during earnings. Season-high options activity in earnings-driven stocks, including NVIDIA, Snowflake, SNOW, and Salesforce, CRM. Salesforce had an implied move of 5%, but only moved 4%, leading to mixed payoffs for options traders. As earnings season winds down, volatility focus may shift to macro-driven options trades, S&P 500, NASDAQ, Russell 2000. The Nasdaq 100 Volatility Index, VXN, spiked above 25, reflecting how tech stocks drove this week's volatility. This week, the VVIX index spiked before settling lower, alongside active downside hedging in the options market. VIX, Volatility of Volatility Index, Insights, VVIX rose, signaling increased volatility of volatility. When VVIX is high, hedging, VIX positions becomes more expensive. Meta-hedging with VIX options also becomes costlier. By Friday, VVIX retreated, aligning with a calmer market environment. Key takeaways from options. Market activity investors aggressively hedged downside risk midweek. These hedges paid off as markets dropped. By week's end, some hedges were unwound as sentiment stabilized. The orderly retreat in VIX suggests no systemic stress. This was more of a quick sentiment reset than a shift in volatility regime. Portfolio managers are likely to maintain some protective positions amid macro uncertainty. Expect continued active trading in index options as traders position for key events like next week's jobs report. Watch whether the VIX remains below 20 or if renewed macro uncertainty sends it higher again. After a choppy trading week, investors are shifting their focus to the first week of March 7, 2025, approaching it with a mix of caution and opportunism. Several key events and economic indicators are on the horizon, with the potential to sway market direction. Strategists are formulating game plans to navigate these shifts effectively. As the new week unfolds, investors will be closely watching major economic data releases and macro developments to refine their market positioning. Next week, retail and tech earnings will take center stage, potentially shaping market sentiment. Tuesday, 3/4, Target, TGT, earnings reports holiday quarter results, offering a crucial read on consumer spending. Analysts expect EPS to decline 28% YoY, 2.15 versus 3.00 last year, on slightly lower revenue. This reflects margin pressures and cautious consumer sentiment. A strong report could reassure markets, while a miss might amplify slowdown fears. Thursday, 3/6, Broadcom, AVGO, and Costco, Cost, earnings Broadcom, AVGO. Key semiconductor and enterprise software player acquiring VMware, expected to report plus 21%, YoY revenue growth plus 137% YoY, EPS growth. AI chip demand and cost efficiencies are driving this growth. Investors will closely watch AI-related enterprise spending commentary, which could impact the chip sector. Costco, COST, a key indicator of U.S. consumer spending trends. Alongside Target, it provides insights into whether consumer demand remains resilient or is weakening. With these earnings reports, investors will gain crucial insights into both consumer and tech sector outlooks. Next week, Costco's earnings and key tech retail reports will be crucial for market sentiment. Costco, Cost, a key consumer indicator, expected sales and earnings growth, EPS 4.10, plus 4.6% YoY. Membership trends and same-store sales will be closely watched for consumer spending behavior. Wall Street remains bullish on Costco. A miss could hurt consumer staple stocks. Strong results could reinforce resilience in defensive retail names. Other key earnings to watch Wednesday, 3/5, Marvell Technology, MRVL, provides insight into 5G and data center markets. Wednesday, 3/5, Scalar, ZS, Viva Systems, Vive Cloud and software spending trends in focus. Thursday, 3/6, BJ's Wholesale, BJ, Macy's, more data points on retail sector strength. Market outlook and investment strategy. With recent market volatility, Costco, consumer, and Broadcom, tech earnings will be pivotal for sector sentiment. Investors may take a more defensive stance by hedging with protective puts on Broadcom or using call spreads on Costco if expecting an upside surprise. If you still want to receive U.S. stock information next week, please subscribe and hit the alarm button. Thank you for watching and see you next week.